All right, this is being recorded, you guys, and I say it at the beginning of every single webinar. Watch this again. First time through, you don't need to take notes. Just kind of listen to it because a lot of information is going to be coming at you. And of course, you're going to have some questions arising. I don't mind if you ask questions throughout the webinar. I want to make sure everybody's clear on concept before moving on. But one of those things that comes with that is that people kind of may get lost in between if I've talked further or gone into detail of something else, and we have to come back to that. People can get a little bit lost. If you watch it again, though, it will make all of those nuances really solidify, and you'll remember it longer. If you watch it a month down the road, it's going to be like learning it all again. You don't have to actually watch this exact webinar, but watch another one. Watch this one or another broken wing butterfly webinar that we've done so that you kind of will get everything that I talk about. Because sometimes I specifically narrow down on one aspect or another when we're teaching these. Sometimes if I'm teaching how to teach options for a wider group, I guess, catch net kind of thing, then I'm going to be teaching it a little bit different. You know, for instance, we're talking about volatility strategies. I'm going to be talking more about volatility and how that affects the strategy rather than some of the other ones. Is the broken wing the same thing as an unbalanced butterfly? Yes, some people would consider this unbalanced in a sense. The broken wing is basically we're selling a synthetic short put spread in this wing, butterfly. We're putting a short put spread in there that finances one side of it is ultimately what we're doing here. Where can we get the past webinars, Herman? You can call us at 310-598-6677 to reach out to us. That will basically show you exactly what webinars you're looking for. It's a little bit difficult when you're kind of going back and forth on emails, finding out exactly what you want. But reach out to us or email us at trading@protraderstrategies.com to get any of that stuff, okay? Do you say selling a synthetic short put spread, David? Yeah, John, I did. When you have a regular butterfly, you know, it's equal distance away. And what we are going to do is we are going to act like we're not actually selling per se, but I'll go through the steps of showing you how it's synthetically, you put in a short put spread into this broken wing butterfly, and it helps you finance one side or the other. I'll explain all that in much better detail here in a minute. Let me go over a couple of things real quick. My name is Eric Wilkinson. Some of you guys may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical market analysis. I've been trading my own money since college with a psychology degree. And then after I realized I really like trading, I switched it over to finance. And upon graduating college, I moved up to Chicago straight away, literally packed my bags and moved straight to Chicago. I never even went home and walked onto the floor of the Board of Trade without a resume and got a job. So for the first 5 years of my life, I've not had, or I should say career, not made up a resume. All right. So let me get this out of the way too real quick. Any opinions, news, research, or analysis or other information contained here is to be provided and considered general commentary, should not constitute investment advice. And I wholeheartedly believe in that statement I just said, you guys. I don't believe in people throwing out trade recommendations. For one, that trade recommendation needs to be appropriate for that portfolio. Two, it needs to be appropriate for that person's risk parameters. And I don't know what those things are for every individual person that's watching these webinars. So how in the world could I possibly say you should be selling puts in Tesla when you're like, I'm bullish Tesla. All right. So that doesn't make sense. Right. For me to do that. All right. So once you have your own market assumption, which you can come up with anywhere, then find the strategy that is appropriate for that underlying and the environment in and around that underlying. You know, I mean, When Yoplait, one of my big trades back in the day when I wasn't trading a whole lot of stocks anymore, and it was one of the things, the catalyst to get me trading stocks again, or actually investing in stocks, more so. I wanted to buy this stock for longer duration, was when Yoplait came out with yogurt drinks. And I was like, God, that's brilliant. You sell me let's just say an 8-ounce cup of yogurt, right? For $1. And then you add water to it and stir it up for me and put it into a 6-ounce container and sell it to me for $2. It's brilliant. And that's when I started buying Yoplait back in the day. I don't have any Yoplait anymore. But that being said, however you come up with your assumption, build a strategy in and around it. It's pretty easy. Okay. And you can even do it when you're saying, hey, you know what? My portfolio is way too long deltas. I need to add some more shorter deltas to neutralize this. Then you can even do that as well, because you're playing with high probability strategies when you're doing something like that with the way that I set these strategies up, if you follow my rules. All right. You can also follow me at Wolfman's blog or our parent company at Pro Trader Strat for market wisdom. For me, if you guys watch the daily market commentaries where I talk about every single trade I do, I actually start out the webinar or those daily market commentaries with going over all the economic data I've seen, any kind of news sources or anything like that that I think might be moving the market on that particular day. I go through the markets, talk about support resistances and all that directional moves I believe are going to happen. And then I go into all the trades that I do, when and where and why I put those on. And then when and where and why I took those off. So I go through all of that. I don't cherry pick. If I have a bad trade, I'm talking about it, you guys. As a matter of fact, I actually talk about the trades I'm losing on more often than I talk about the trades I'm winning. The winners are easy, right? They're in, you're out. You don't ever have to think about them. But the losers are the ones we have to stay mechanical with, and we have to be diligent about making sure we are doing everything possible to be mechanical as well. All right. So I go through all of that stuff in the daily market commentaries. And, you know, if something happens late in the day, like I had a John Deere trade on, I was talking about in the daily market commentaries yesterday, I said, I'm going to get out of this trade by the end of the day. Well, when I got out of that trade, I tweeted it out. Hey, you know, just a heads up, FYI, I'm out of this John Deere trade, and then talked about it again today in the morning market commentary. So that's kind of how I roll with that. All right. So this is another broken wing butterfly. This is on the put side. And so I think somebody was asking about it was a wounded wing or an unbalanced butterfly. If it's an unbalanced butterfly, the more I'm thinking about that unbalanced butterfly, as long as it's just you're skipping a strike and it's not like the ratio isn't out of whack for a butterfly, being that you're buying one, selling two, and then buying another wing. All right. As long as you're doing that 1 by 2 by 1, then that would be probably fitting in and along the lines of a broken wing butterfly, which is what we called it on the floor. Everybody's kind of got their name for it, but the broken wing was what we called it. And you could say it's a skip strike butterfly or a wounded wing butterfly is what I've also heard of. I don't know if I've necessarily heard of, John, an unbalanced butterfly, but it very well could be a very similar situation here where we're talking about the same things, but they just have a different name. So what is our market assumption with this, right? One of the first things we need to know before we're getting into any strategy or implementing any strategy is, what is our assumption for this underlying? And for this underlying, our assumption is it's going to be neutral, all right? We're going to be slightly bearish with the way I set it up. And that is just because I like to set this strategy up just out of the money, but it will eliminate all risk to the upside. So that's the beauty in this. You know, in a market like we've seen now where the market's really rallied up, we're seeing some kind of economic data that may not be as good as we were all expecting or hoping, but not enough to like put us into a recession. Okay. We aren't seeing those kind of economic data points right now, but we might not see the exuberance we're seeing in the markets right now. So we could see it kind of correct, which is in line with what I've been talking about in these daily market commentaries. I thought we got a little frothy to the, actually, I thought we got a little overdone to the downside, if you guys remember, and then a little frothy to the upside. So I'm expecting this to come down just a little bit more and settle down for a little bit for about a month or so is what I'm kind of expecting here. So that would fit my market assumption for just about everything. So know that when I'm coming into this, some of the underlyings I'm looking at may very well be according to the market assumption I see. So if you guys don't agree with my market assumption, I am absolutely fine with that. So I would much rather you guys have your own market assumption and we talk through how to build a strategy in and around that. Because I'm not always right, you guys. As a matter of fact, I'm probably wrong more times than I'm right. But I play the probabilities, so they are so much in my favor that I end up, you know, ultimately ahead for the last 25 years, okay? What time does your living room start and end? Are you talking about the Tanya, and we're going to start membership in April? Yes, I'm going to be starting to do these. John's asking about some morning live rooms where I kind of go through and I'm going to maybe switch around the morning market commentaries, make those for people so that they can view them live as well. And we're working out those details, John. I haven't gotten all of that information down yet, but we are working on that. All right. So a couple of other things we got to look at is not only having that neutral market assumption, right? We have to have that market assumption, but with the broken wing, put butterfly, we need high implied volatility percent. That's above 50. And the reason why is implied volatility for any given underlying kind of acts like anything but the example JP showed us before the start of the day here with a trade that goes from 0 to 70 on any given day. But let's just look at, say, Twitter for some reason. It's the first thing that's coming to my mind. But we could look at just about any stock. I don't know why Twitter came to mind first. But what we could do is look at a stock and say, you know, when we're looking at this stock, it has a tendency to stay within boundaries, right? You know, 26, if it got down to 26, that'd probably be a place that I'd start looking to buy, and I'd probably look to start selling it up around 47 or even probably closer to 37. I would be thinking I could sell here because, you know, although this is an anomaly and it broke out of the range, it has a tendency to have support and resistance levels, major support and resistance levels like these, okay? So as you can see, it's going to want to go down to 26. It'll go up to 36 and back down to 26. Same thing happens with implied volatility. It's going to have, Twitter is going to have extreme volatility when it gets up into the 80s, okay? It's going to have extreme low volatility when it's down here in the 30s, okay? So we could look at another stock, completely another stock, and its implied volatility may be at an extreme high when it's trading at around 40, where for Twitter, it's really, really low, okay? So we don't want to just look at the implied volatility. We want to look at the implied volatility, how it is in relation to where it's been in the past, because although it can break out of those ranges, you can see that volatility has a tendency to kind of run with a charting pattern where they have support and resistances, okay? But this tells us if we're at an extreme high, that's probably where we should be selling that volatility. And when it's at an extreme low, that's where we should be buying it, okay? The only way to tell that is to find out if 41 IV is high or low for Twitter. We don't know unless we do this ratio and we take a sum in the numerator and divide that by the sum in the denominator. The sum in the numerator is basically taking the current implied volatility of 41 and subtract it by the low, which is 30. So we have, let's say, 11 in the numerator. And then in the denominator, we take the sum of the high, which is 90, minus the low, which is 30. So we have 60 in the denominator, right? So 11 divided by 60 gets us into about a, what is that? About a 15, 20 IV percent. So what we do so once we come up with that math, we would realize that Twitter would be too low for this. If we did that math and the sum was above 50, that would tell us that it was in the high implied volatility percent range, according to our rules, being 50, okay? There's a couple other places you can find that number on TOS as well. And if I pull up the platform here, we can find it in the option montage. So if I ever refer to the option montage, basically it's the trade area where all of the options pricing is, okay? That IV percent is also not this percentage over here. This is implied volatility as well. What we're looking for is the implied volatility percent, which is currently right here, 25 IV percent. Now remember, my math, I was doing it ballparking, so I was obviously off. So 25 IV percent, and you can pull it up in the watch list over here as well. If you don't have that, you're going to have to go through the math like I went through. Take the current implied volatility of the underlying, subtract it from the low, and take that sum and divide it by the high minus the low, okay? So that's how we would come up with the implied volatility percent. So we need that to be above 50 in order to do any type of premium collection strategies. And the broken wing butterfly is going to be a premium collection strategy when you set it up like I do. If you ever set this strategy up and do it for a debit, I'm going to come over there and wring your neck personally. No. Don't ever do this for a debit. There's a reason why. If we are going to be increasing our risk by that synthetic short put spread that I talked about, all right? That synthetic short put spread, because we're selling it, right? Selling a put spread is adding more risk to this strategy. But by adding that risk to the downside, what I've done is I have I've taken away my risk to the upside completely. All right. So in my eyes, you have to weigh the benefits, right? I can kind of make this where I don't have to pay as much or I get a credit. Therefore, I'm willing to increase my risk a little bit on this side if I can completely negate the risk to the other side. Don't increase your risk to one side while you still have risk to the other side. That doesn't make sense. So we have to have a situation where we are either able to collect a credit, which is what I prefer to do, collect that credit, because if you're wrong, you get to keep it, and or zero, no outlay of cash. Do not do it for a debit because then you have risk to the upside. If you do it for a debit, you have risk on the upside. You've increased your risk and you haven't really negated a whole lot of risk on that upside. All right. So how do we set this bad boy up? We're going to set it up by, like I mentioned, buying an in the money or just at the money. I prefer to try and pick that one that is just, at the money or just slightly out of the money there. I don't necessarily like to go into the money. All right. But definitely selling these two puts, we're selling those out of the money. And then we're skipping one strike. So if this were $5 wide from the one we bought to the one we sold, then this one would be $10 wide down. All right. So it would be like the 100, the 95, and the 85. We're selling the 90 puts and buying the 85 puts. That's where that synthetic put spread comes from. I'll go over that again here in a minute when we pull up the option montage and pull up our own trades. All right. The keys to success, picking the right environment. Well, we've already come up with the fact that we have a directional assumption, all right? So if we have a directional assumption of market neutral and we're thinking there's broken, I'm a little bit worried about the upside, a little bit worried about the downside, not worried at all, about this really tanking, but I think it's going to stay right here. And if it goes higher, I don't care. I'm not going to lose money kind of thing. But the right environment for this is that high implied volatility percent that I said. we need to have an IV percent of above 50. And we can see Apple is pretty low just by guesstimating, right? We could say that an IV percent of about 33 or something like that is probably close to about a 50 IV percent by just eyeballing it, right? So we can tell we're way below that number. I can probably find it over here. It's a 25 IV percent. So we would need to go to the ones that are up in and around this way. And I want something that's above 50. Now, you can see I don't have a whole lot to pick from. A lot of these have earnings in them. I don't want to set this strategy up for an earnings trade. That is, 6, 7, 10 days away, all right, with this strategy. I want to set this strategy up with a clean month, being something like with Twitter or whatever, where there is no binary event, which is an earnings. This comes after this line, which means that this is a clean month. This binary event is any known event that could cause major fluctuation in that underlying. FOMC meetings for treasuries is a big one. Okay, so you can think of that. Biotech, like JP's example a minute ago. Maybe they came out with a drug result that knocked it out of the park. That could have been something like that where the volatility spiked for that. So you will see those kind of situations for biotech, and that kind of binary event will affect the volatility. So we don't want a binary event, because if that binary event just landed inside here, maybe it was on the last day, we would expect volatility to ramp up going into that binary event. You can see heading into binary events, volatility gets to its highest peak at that binary event, right? And this is the case for most stocks. It's not just Twitter. And then after that binary event, the volatility comes out. What we're looking for is something like this, where it is high outside of a binary event, and we can get that volatility coming out. All right. The idea is we want volatility coming out of this strategy throughout the time that we have it on. So we need to pick an environment where it has high volatility, and we would expect it to come back down, right? Just like when it reaches those extreme levels, that's how we take advantage of it. All right. So that's what we're looking for. Implied volatility percent of above 50. Slim pickings right now. And that's because we had that major volatility not too long ago also. All right, picking the right underlying. Not all options are created equal, okay? Like stocks, we've all heard of and maybe even traded. We've all heard of Apple, and it's a pretty popular stock. What we do is we help the price of the underlying and go over to the option montage. We move this 3 ticks to the left, the decimal point, 3 ticks to the left, and we have 17 cents, right? So any stock over $100 moving the decimal 3 ticks to the left, 17 cents is how wide our bid to offer should be in the option montage. That is the spot month. Okay, spot month is the closest major month to expiration. Now, yes, you can look here and see March. Oh, wow, that's a major month and it's got 8 days left. Well, people are really trading this. This isn't the spot month anymore. People are rolling out of that into the one that's closest to 35 days to expiration. That's usually the spot month, okay? This is the spot month at this point. So we're looking at the spot month for Apple, the option montage closest to expiration or 35 days to expiration. Is it within that threshold? 18 cents, yes. Okay, you can see that happening. We could go over and look at something like Aon, and Aon will sometimes, and used to a little bit better, come in closer to that. Now, this rule also needs to apply during open market operations, all right? After the market closes, people pull all their bids and offer, and they get a little bit wider. But I can assure you, I can assure you one thing, that it's not going to be this wide during open market operations, but it doesn't fit the rule of being 16 cents to the bid offer on this. It's usually going to be like 25 cents, almost double what that threshold is. So that, in that case, I would say this would be a red light, especially for a newer trader. Now, if you're used to trading options in and around one of these underlyings that doesn't fit my rule, just know that when you're looking at that, you're kind of getting a yellow light, and a yellow light, if you get too many of those, right, then you really want to probably pass on going through that intersection, okay? You get one yellow light, it's like it changed right before you started going into the intersection, so you're probably okay, right? But too many yellow lights, you've kind of gotten away from the keys to success. So picking the right underlying, $100 stock or greater, move the decimal place 3 ticks to the left. That's how wide the option montage for the spot month should be. If it's under $100, for instance, like Morgan Stanley, we need to have the option montage be at least 10 cents or better. Okay, so from 40 to 50, and that fits this rule. So, you know, stock under $100, we need the option montage to reflect less than 10 cents to the bid ask on the spot month for that to fit my rule. Okay. So picking the right underlying is making sure we have a tight bid ask. The reason why we want a tight bid ask, it's so then you don't have to give up a lot of edge. Remember, we have 3 legs of this strategy, and the more edge we have to give up to get into this strategy, we're going to have to give up that same amount of edge to get out of it. So if you're giving up 20 cents on either side, you know, of those short legs and 20, you're really giving up too much edge, and it's just, you're going to have to sit on this position for quite a long time. You'd rather have a lot of eyeballs on it. So if you make the market slightly better, somebody else notices that and makes their side a little bit better, and then you kind of meet in the middle. It's, you know, it's basically you're bartering back and forth and trying to dicker down to a price you both can live with. All right. So picking the right underlying, we need tight bid ask. The duration, we're collecting a credit. This strategy we've talked about, we need high implied volatility. All right. We also want to pick that option strike that is going to get the most theta decay. And this is a representation of at the money calls and at the money puts. And you can see that these are the days to expiration, DTE, days to expiration. So further out you go, this line, you know, gets flatter and flatter. We start seeing this theta decay kind of flatten out a little bit. All right. I tried to make that look like it's flattening. So it's going to get flatter and flatter the further out, less theta decay per day. Inside of here, though, 35 days to expiration, we get a massive amount of theta decay, almost 50% drop in this little area. So if we started out at $2, it's going to be $1 by the time with the underlying not even moving in price, all right, with volatility not changing. Only thing changing is that daily theta component ticking away, all right? So we want to get to as close to 35 days to expiration as we can, because that's where we see the best theta decay happening. Another thing we see happening before we get into the strategy like we're talking about now, if volatility starts coming into this market, what happens is volatility starts holding off theta decay kind of synthetically. Again, it's not a real happening, but it feels like it does. And then when that volatility comes out, it has to race to catch up to where it should be. And in the meantime, we're trying to get in around this area where volatility's gotten that peak and we start seeing it come out. We can take advantage of it. Our premiums will deflate, and we've collected a credit, right? So those premiums deflating will help us, all right? And so will the theta coming out of it, because it's going to affect our short strikes quicker. What about the jobs report tomorrow? Herman, I don't worry a whole lot about the jobs reports when I'm trading stocks. I would worry about more of my bonds and stuff like that. I think they're going to get affected a little bit more. I'm not too worried about that number tomorrow. But, you know, if you don't like trading around the binary event like that, I would totally get that skipping out of this strategy, implementing it today ahead of that number. Okay. Unless you were doing it specifically for that volatility coming out. Why is there a difference between the MMM above at 0.9 and the IV? Okay, the MMM is the predicted market maker move, and that's based on the straddle. Okay? Does that make sense? in the option montage. So like this doesn't have an MMM because it doesn't have an option. Was it Twitter that had that? I doubt they did either. Well, they do though. And it's 12 cents. Okay. So this 12 cents, it's based on probably the straddle here, although, and this is going to be for the next day kind of thing. But they don't have an earnings, I don't think. So I don't know why it's, sometimes it won't even show it if there's no earnings there. So use this on a pre-earnings run up for the crush afterwards. You can, but I have specific rules for earnings trades. Good one. So check those out on how to set it up, when to get out of those trades. I have rules for that. This, I'm just picking anything that has really high implied volatility and I expect it to come out. One of my examples that I had kind of vetted for today, and we'll go over it in a minute, was one that had an implied volatility above 50, but it has since come off a little bit. So we're going to have to say it's going to be a yellow light for purposes of the webinar if we use that example. All right, and picking the right strikes. This is important to the point where we do not pay for this strategy. We need to collect a credit or do it for no money laid out. All right. And I'll show you on the option montage. Let's just go through an example real quick of how we build this thing out. I'm going to do it a little bit earlier than I normally do for picking the right strikes because we got to do this for a credit. So I'm going to go look at Amgen. Amgen, because it was one that was above 50. It doesn't have a binary event in this April or in the, what is it, the May contract now? April contract. It is the April contract. I did this strategy for myself because I was slightly, or I'm bullish in Amgen to the point of I really don't care if it goes and sells off. It might come down to here or whatever. But I was able to get in below the 52-week low with the credit collected and the strike location. So I'm definitely good with that. But you could be like, it's going to go down there, or it's going to go, let's say it's going to go down to 70 or something like that. Whatever your market assumption is, it's going to break through here. It looks pretty weak. It's going to go to 70 and it's going to settle down. That's your market assumption. Or it's going to stay in and around this area and settle down. This is where the support has been. Whatever your market, however you come up with your market assumption, okay? So in this, what we are going to do, and this is just a placeholder. I put these in my real trading account and I put them in here for daily market commentaries and stuff like that to talk about. So we'll do it the same here, and I don't really. So what we're going to look at is, I told you I like to go with the ones that are just outside of the money, and these 180s are. So, and we can look at the one in the money as well. But I kind of like to go just out. So I'm going to go buy this one, and I'm going to go down to, excuse me, let me make this a little bit bigger. Can you guys all still see that? Seems like some of it's coming off. Doesn't want to fit onto my screen correctly. All right, so I'm going to buy the 180s, which is just slightly out of the money, right? Because it's trading 181. I'm going to sell two of the 175s. And then I'm going to, on a regular butterfly, what are we going to do? We do the 80, 75, 70, right? So I'd go in there and buy this one. That's your regular butterfly that we talked about, right? How do I break the wing? Well, I get rid of this strike. Well, how do I get rid of that strike? I sell the 170 puts. I sell the 170 puts and then buy the 165 puts. That's that synthetic short put spread I was talking about. You see how I put in a synthetic short put spread, you guys? Because that's really important. Because if I looked at it, I sold this 170, bought the 165s, right? That gave me an 87-cent credit synthetically. Okay? And it also created a situation where I'm good to the upside. Hold on a second. So that's that synthetic short put spread. Does everybody get that? Something's not right. What happened? Did I get really quiet? It's because my son is pounding on the front door and trying to get the dogs riled up because he forgot his key. I can't help that at this point. I'm in a webinar. He's going to have to wait. Okay, so do you guys or he can walk around to the, he can walk around to the back door. The strikes here. No, all I'm saying is if I buy this one, sell this one twice, right? That's that's a regular butterfly. If I come in and sell this, buy that one, that's the broken wing butterfly. I broke the wing. But what I'm also saying is this, by selling, that's the synthetic short put spread. Does that make sense? So we buy this one, sell this, skip this strike, and buy this one. Right? Same thing, but there's a synthetic short 70-65 put spread in there. That short put spread allows us to have no risk to the upside. And you could do it with the ones that are the 85, the 80s, and skip the 75s to do that one. You can do that as well. Okay, you can go in the money. Because volatility is high, I bet I can go to the 75, buy two of the 70s, skip the 65s, and sell I did that wrong. Sorry guys, what was it? Buy the 75s, sell two of the 70s, and then skip the 65s to buy that. Still gets a credit. What happens if we have really low implied volatility? You know, I'm telling you guys, I need high implied volatility. Let's find something that's a stock $180. What stock's got low implied volatility that's about $180 that I can quickly find? Apple. So Apple, let's throw Apple in there. AAPL. Apple. It's a $170 stock. So it's close enough, right? Can we say it's pretty close enough that it should still come close to fitting this rule? But it's got a 25 implied volatility percent. Let's try the same thing. We're going to buy this one. We go down one strike, sell the 65s. And this one is no further out of the money necessarily than the other one, maybe by about 50 cents or so. So it should still work. 65, skip this strike, and then we buy that one. It's a debit. All right, let's try and do it where we have to go in the money. Buy this one, sell that one, skip this strike, and buy that one. That's the only way we could do it, where we have to go into the money, all right? The other one, we basically coming out to this like 65 here and being able to do it. But I can't do that when implied volatility is low, because volatility inflates these premiums. It allows you to get further away from where the underlying is trading because the market is expecting an outside move. All right. With this strategy, we're able to get all the way out to basically past where, or at least to where a 1 standard deviation move is for where our break even is. That's pretty darn good. All right. But when you have that low implied volatility, that 1 standard deviation move is expected to be really close. We want to get really far away so we limit our risk. And one thing fear tells us, or volatility tells us, is a fear indicator. And fear is always overstated, don't you think? I mean, when somebody's scared of something, whether it's a clown or a mouse or a spider, you know, it seems to be a little ridiculous or overstated sometimes. Well, fear gets that way. Fear makes people do things a little irrational, right? So we take advantage of that. We come in and give them comfort. I'm there for you. I'm there to catch you when you're scared. That's my job. And to take your money. All right. All right. Knowing your exit strategy before entering the trade. I say with all of these rules, you guys, time and time again, write them down. I've gotten rid of a couple of my 3-ring binders recently, but I have three ringed binders sitting right here on my desk where I write down all my trades every single day, why I put them on, when I'm planning to take them off, and all of those things. Yeah, you probably write them in notes in your platform. I like to have them right here. And what my exit strategy is. And the reason why you need to write all these things down, for one, you have data to go back and look at to see if you are following the rules, being mechanical, and ultimately it will make you more mechanical. You'll look in there and be like, I set this strategy up for this exit. I need to get out at that exit. I can't tell you how many times I've watched people trade and say they were going to get out a certain place. They didn't get out at that place because they thought all of a sudden it was going to be a huge winner, and it's gone back to bite them in the rear end. It's happened to me. I've talked about it in daily market commentaries. I make those mistakes sometimes where I'm like, I'm going to squeeze this one out, but I know I'm going to do it for these various reasons, and it's come back to bite me. And I've said, oh, there you go, guys. You know, I make those mistakes too. You have to weigh, you know, the benefits versus the risk, though, sometimes. And sometimes it's worth it. All right. So broken wing versus the traditional. I've kind of gone over this a little bit already, but for the Analyze tab, this is your traditional. And then your broken wing, you have risk to both sides, right? By increasing the risk to one side, what we've done is so that increase the risk to the downside, but we've eliminated all risk to the upside. So what that synthetic short spread does, it will increase what your margin requirements are for this, though. All right, because think about it, you got that synthetic short put spread in there. That's where that extra margin requirement's coming from. Okay, so just know that. All right, so our profit target is 50% of max profit. If I collect, you know, if I'm able to collect $5 for this strategy, then I'm going to be looking to get out at $2.50, which would be 50% of my max profit, right? How do we figure out our max profit, though? You take the higher strike minus that middle strike plus the net credit. So basically, it's the width of that smaller spread, not the broken wing one. It's the width of the smaller spread is our plus the credit we received is our max profit. So if it's a $5 wide spread, like we were using those couple of examples like Amgen, and collecting 46 cents, let's say, $5 wide, collect 46 cents. Our max profit is $5.46, okay? And our max loss is going to be the skipped strike minus the lower strike. So our max loss is actually less than our max profit, okay? So our risk is less than our reward. Right? Because our max profit is $5.50. Well, if we skip the strike minus the lower strike, it's that width of the spread, right? Minus the net credit. So if it's $5 wide and we collected that 50 cents, our max loss would be $4.50, whereas our max profit is $5.50, right? Because it is the width of the spread plus the net credit. This is that lower strike minus minus the net credit. And then our break even is the skip strike minus the net credit. All right. And the reason why and I'm going to pull this up for purposes of your viewing pleasure. Let's go back to this Analyze tab. I've got this all set up, right? Let's do it with Amgen where it's a better example of correctness. So Amgen. So I'm going to go with this example. We're going to buy the 80s, sell 2 of the 75s, and come out and buy, you know, I'm going to actually buy the 65s. Hopefully this doesn't get screwed up with my position that I have loaded in there already. So let's take so we're getting a 30-cent credit. So let's analyze the trade, take off this part of that trade. We just want the butterfly. All right. So just the butterfly being shown here. So what we have is the underlying is currently trading at 181.46. This is where it's at. If the market goes higher, we get to keep this 32 cents. All right. We don't have to worry about it. We stay profitable on any upward move, but we think it's going to come back down to where that volume node, let's just say for example purposes, I was talking about in the chart. So we think it's going to come down somewhere in here, right? That's where our target is for this trade. So our max profit right here is the $5. It is the width of the 80 to the 75. All right. So we bought that spread, sold this. Now, if the underlying goes down, right, comes all the way down to here. Our max profit is basically based on the width of this long put spread, the 80 to the 75, because then we get to keep all of that credit. Well, we get to keep this credit, and we get to keep the width of the spread because it came down and landed on the 75s. We get to keep that $5. But as the market continues past this short strike of the 75, we start losing money on those 75s, right? But we collected $5 up here, and we get to keep that $5 for that put spread, but we start losing money on the way down. So once it gets past that $5 getting made up, that's where we hit our break even, right? See how that happens? So we're making money when we got that long put spread, but then the short put spread starts hurting us, right? And then, you know, once we get past the 170 strike, which is that skip strike, we can lose that balance. So our credit of this long put spread, the $5, is eaten up when we get to the 70. And then we would start losing money. But we aren't going to lose more money than we have a possibility of making. And we won't lose any money if it goes higher. Does that make sense? For our break-evens and stuff? All right, so like I mentioned, you guys, this is more so than anything, we're doing a play on Vega because we are coming up with it, not only the assumption of market neutrality, but we also think if the market is going to stay neutral, right, in line with our market assumption, we can assume that volatility is going to come out of it. All right, so we're playing that assumption. All right, and we're good with that. The reason why we need that high implied volatility in the beginning is so that we can have more wiggle room to be wrong. All right, it also allows us to collect a credit for this strategy. And we're also going to be exploiting theta because we talked about that in that trajectory. We want to kind of get inside of here, right, where we get that major down theta decay, okay? So we want to exploit this theta decay. That's why we're getting in as close to 35 days as we can. And we're going to play on the Vega because we know it's high. You know, when markets do this, even Vega, and it gets up here, what do we expect it to come out, right? Does that make sense? John, I cleared up the strike thing, right, for you guys? I don't see any other questions coming up real quick. And Nancy, we have the link fixed for all you guys that I know we had a lot of you guys that finally were able to take advantage of this 2-for-1 deal. Basically, you get the options trader hack. It's usually $4.97, and this volatility crush course for $4.97. We're taking that, and basically it's 2-for-1. So for $4.97, you get both of them. All right. The link was wrong before, so a lot of you weren't able to take advantage of this two for one. So it's both for $4.97. If you're watching this on tape delay, you're going to have to pause it, punch this into your URL. If you guys are watching this video at home live right now, it is in the chat window. We've been talking back and forth in this questions box. You've seen those kind of going, well, I don't know if you guys actually can see that, but you guys have been communicating with me in the questions box. That's where I'm reading your stuff. You'll have to go over there to the main control panel for a GoToWebinar, find chat, hit that little drop down window. There should be a link in there for this deal. The trader hacks, you guys, will streamline your life. If you're going through and doing all this math, like I was talking about with the implied volatility percent and doing all of those things, I have hacks for that. I have hacks for discerning probabilities of success and all kinds of other beautiful little webinar, little videos and stuff like that. So you get that for $4.97. That will streamline your process, save you like 30 minutes a day. If I could save you 30 minutes a day, I mean, wouldn't you guys be loving me? And then on top of that, I'm going to give you guys an opportunity to sleep at night. That's what this volatility crush is going to do. You will understand volatility crush to a point where you aren't going to be worried about all of these ancillary things, all this noise that goes on in the markets, okay? You're going to streamline your process. You're going to be able to get done. You're going to be able to go through many more opportunities in the same amount of time, get that done and out of the way, and then you're going to be able to go home and sleep because you know you are mechanical and you've done everything you can in order to be successful. And the probabilities are in your favor. And when you know the probabilities are in your favor, you will be able to sleep, I'm assuring you. So this is well over probably 15 plus hours or so. And then you also get these. The nice thing is once I've watched this video, I can just hit the check mark box and I know I've seen it and I don't ever have to watch them again if I don't want to. And once I get through them, then I can go back and watch them again. It's up to you. Once you guys have taken advantage of this opportunity, it's yours, all right? So take advantage of that. The link is in the chat window. If you're watching it on tape delay, like I said, you're going to have to watch it or you're going to have to pause it and type it in. Last thing, I just want to thank you guys all for attending this webinar. It's been great. I love the participation back and forth. Believe me, it makes my life so much easier. I realize that you guys are understanding it. And the question, if you guys are asking questions, somebody else has that same question too, you guys. So it's great that you're asking those. But later webinars, I'll be drilling down on different option components, how I trade options and when or where I find those trades appropriate. There's the link again. You'll have to pause it and punch it into your URL. I want to thank you guys all for watching. If you guys want, somebody was asking about specific other webinars, past webinars, and you wanted to take advantage of some of those, Herman, you can reach out to us at 310-598-6677 or email us at trading@protraderstrategies.com. All right, that's all I got. But Poor Man Covered Puts is in there. Yes, we do have that webinar. That is one of our favorites for sure. As a matter of fact, Mary's piping in here and something about AFTA, which is her trading group. I did the Poor Man's Covered Call for them, but I do have the Poor Man's Covered Puts in there as well. Mary, what were you saying? The question from the hacks. I'll make sure you guys are taken care of. I thought that was already done. All right. That's about it, you guys. Like I said, take advantage of that. You will be able to sleep at night and it will streamline your process, you guys. You will be able to look at the option montage. When you look at the option montage after watching those, it will be completely different. You're going to look at it and be like, wow, why did I go so long without knowing this? And you're going to flip through and just be like probabilities. You know, it's going to be like a beautiful mind. Everything starts coming together. All right. So take advantage of that. All right. That's all I got for you guys. If you can't take that, take it easy. What was that, John? Should the max loss be the skip strike minus the middle strike? So let's just go over it real quick one more time because somebody else might have that same question. So the max loss is the skip strike minus, so the skip strike is the 70 minus the 65, right? So that's $5 and then minus the credit we receive. So $5 minus the 32, we come up with $468. Well, and it's really this one, the skip strike to the 65 is where you're losing the money. That makes sense. So from 70, because the long put spread gets us our max profit. That long put spread also covers a lot of our risk all the way down to where we skip that strike, right? And then from that short strike, the synthetic that we got out of, the 70 to 65 is $5 minus the credit is 32 cents. Cool? You got it. Sweet. Awesome. Great, guys. You guys have a great weekend. Hopefully we can get some volatility back in these markets for the last couple of webinars. Otherwise, we'll be using examples that have earnings in them. Again, there's the link at the top, you guys. Or it's in the chat window if we've been chatting back and forth. I appreciate you guys all sticking around a little long today. But that's all I got. Take care, everybody.